Wondering how real estate investors secure financing to fund their deals? The options might surprise you. In this video, we're going to talk about, why financing is one of the biggest hurdles for aspiring real estate investors, but knowing your options can help you take action today. In this video, we're going to break down the different ways real estate investors can get financing, including traditional and some creative strategies. So first, we're going to start off today talking about traditional financing options, Paul. And we'll start off on maybe conventional loans. You want to talk about them a little bit?
Yep. Conventional loans basically require somebody to put around 20% down. And you could be a little creative. You could do, 20% down or 10% down. There'll be an 80-10, a first and a second. Conventional is your most basic. It's the most qualified borrowers out there.
Yeah. And then another way for people to tap into is just existing home equity line of credits on your properties.
Yeah.
If your property, just easy numbers here, is worth $500,000 in today's market values, but you only have a $200K loan on it, you could tap into almost up to $300K on the difference there. And you could just use that essentially as cash, buy the property, make renovations, and then refinance out if you want to keep it as a rental, or just sell it and pay it back to a HELOC. So that's another option where you only pay interest only on like a HELOC. So, Paul, what are some non-conventional ways, such as like government-backed loans out there that you could cover?
So you have FHA, which is probably your most common one out there.
Mm-hmm.
And that one you could put down as little as 3% down on it. And there is mortgage insurance on that, a mortgage insurance premium, which goes on top. So let's say your principal and interest is $1,600, you might have $150 PMI on there as well, tacked onto it. So it's a little bit more pricey. It's a little bit more risky of a loan. They allow higher debt to income ratios on that, as well as the USDA mortgage, which is the rural homes. And you have to qualify by being in a rural enough area for that. And then the VA loans, which of course, military loans. And they're probably the best because both the USDA and the VA allow for 100% financing, and there's no mortgage insurance on that. So those are definitely very good government loans.
And the FHA ones probably aren't going to be ideal for a fix and flip because it's going to need a lot of repairs. A good example would be me personally, and I know others that did this, where if you're a new investor and you want to purchase like a small 1 to 4 unit multifamily property where you live in one of the units and rent out the others, that's a great way to get cash flowing property living in one of those units. And you're only going to need like 3.5 down basically on that loan. So that's probably the ideal scenario for that FHA loan for an investor perspective.
I would agree. Like, the VA, and you did this, Mike, your first property was a multi-unit that you bought. But if you get a VA mortgage and have a nice low rate on it, 30-year fix, it's 100% financing. You got a nice cash flow, you get something that not many people can qualify for.
Exactly. All right. We talked about conventional government. Now let's talk about a little bit alternative finance options. Some of the ones that kind of come to mind are like bridge loan types. So like hard money and private money. What's the difference there, Paul?
So your hard money is like Kiavi, Lima One Capital, your asset-based lenders out there who typically charge you anywhere from 10 to 12% and 2 points or 1 point, depending on how well you qualify, up to about 3 points. You also have some hard money lenders out there, and they're kind of fading away, Mike, because the asset-based lenders have eaten into most of their market share. But back in the day, you remember back in early 2000s, they were 15% and 5 points. That's where they kind of started when you were out there.
Yep.
And then, of course, the best and what we like to use the most is private lenders, right? Where you have a fixed interest rate with them. You may have a set minimum, but usually no points. Although occasionally you'll get some that want points as well, but maybe a little bit lower rate. So depends on what the private lender wants and what your business model is. But the private lenders are our bread and butter. They're our favorite. We utilize them the most.
Yeah. And then just from application processing too, most private lenders, it's going to be less paperwork than from an application perspective than a hard money lending companies too. Both pros and cons to each, but those are kind of like the differences. You got to figure out what's best for you. And again, we utilize them all. So there is no right answer. Just it's another, you should have these two types of lenders in your toolbox basically when buying flips or rentals. All right. So we talked government, conventional, some alternative kind of like private money, hard money lenders. Here, let's talk about some creative financing strategies now out there. And the ones I want to cover, Paul, seller financing, subject to, and maybe some like partnerships even. Want to share some of your experiences there?
Yeah, I mean, a partnership is probably one of the most common out there for when people first get started. Somebody has money and somebody else has the hustle to go out
The
there and
deal.
find these deals, right?
Yeah.
And they share, whether it's 75-25, whether it's 50-50, that's amongst the two to decide there. But that's a great way to get started. And you can get it started with no money down, no capital at all. You're just partnering
Yep.
with somebody who does have capital. Great way to do it for sure, 100%. What was the other one you asked about?
Yeah, so partnership is a good one, and usually you could, and it doesn't have to be a true partnership. It could just be a JV on one deal too. So that's just something that for people to be aware of. And then the other two I asked you about, like any experience in sub two or subject to financing and or seller financing.
Yeah, both are great. Subject to where, a lot of people have 4% or lower mortgage rates are great to get in this market where you're basically taking over their mortgage payment and whatever they have and then giving them some walkaway money, some cash, and you got a cash flow rental in all likelihood, depending on where you are and what price
Paul, you
point it
cut
is
out.
and what the rents are looking like in that market. And then you have seller financing where people are going to sell it to you and maybe you're paying a premium, but maybe you don't mind because sometimes you could do it with 0%, 5%, 7, 8%, depending on what you need to do to that property to get it up to rentability or to flip it. I mean, seller financing is a great way to do it. It's a powerful tool.
Yeah. And then what do you see funding for rental properties out there these days? So it's already fixed up, right? And you're gonna cash out of your bridge loan essentially, your higher interest rate loans that we talked about earlier. What are some good loans out there for rental properties?
This is where the asset-based lenders are even more aggressive right now. It's probably their most favorite single-family housing or up to 1 to 4 units, under 5 units. They are loving these financing right now. You're getting pretty favorable terms, not too much higher than your typical conventional or FHA mortgage rate, and more favorable terms. So if you can get something, if you have 20% to put down, you're going to have a very good long 30-year fixed rate cash flow property, right? You just have to have some capital to put that down there. Or you purchase the property using a bridge mortgage, renovate it, refinance it, and then get your money back, pay your private money lender off, and then you have a cash flow rental.
Yeah. So for folks out there watching still, it's tips for securing real estate financing. It's prepare your financials because whether it's a private lender or an asset-based lender or a bank, these lenders are going to want to see that you have strong credit, income stability, and a solid investment plan. Like, what's your plans for the property? Hopefully, if it's your first deal, you're not going to have a track record, so you gotta bring all that to the table. You also got to build relationships with multiple lenders. Just don't go after hard lenders, right? Like, go after private lenders. Make relationships with conventional banks, et cetera. You don't want just one tool in your toolbox from a lending perspective. You want multiple options out there. Figure out what's best for you. Products change all the time. Research them. Sometimes a lender might charge 12% 1 month, 15% the next, 9 the next. They're constantly changing from their risk appetite. So it's just because you got rates for this month from a lender, it's going to change over time. Points and interest rates. Start on smaller projects, something more palatable. You'll be able to get more financing for something that's easy and you're highly likely to execute on. So those are some tips there to secure real estate financing. And, just to recap, traditional bank loans to creative strategies like seller financing, there's no shortage of ways to fund your real estate investments. So if you found this video helpful, hit the like button, subscribe for more real estate tips, and share in the comments what are your favorite financing strategies out there.